Awesome. Now that we're recording, I'm not going to go back and say all that again, but you guys get the gist. We're happy to be here.
So yeah, like Devin said, we help our past clients, we help our family members, we help friends, other realtors do this along with us. And we'll get into it. What we specialize in some syndication. So basically pulling money from people we know, people we like, people that want to help grow in their will at the same time. It could be you, it could be another agent across from you, it could be family members. So you pool your money, you buy these buildings, and this whole, we're going to come back once a month and do this, and we're going to take you from A to Z on how we do everything we do. So this first one's going to be about choosing the market specifically, basically show you how we evaluate markets, why we choose where we choose, and all that fun stuff. Yeah.
Yeah, so this is a little bit more about us. So in that journey, since we started selling real estate in 2018, we've sold 150 million in Los Angeles, and we've taken pretty much all the money that we've made in that and put it into these apartment buildings. And those apartment buildings now, it's a portfolio of 388 units across 5 states, and the value between 40 and 45 million. And our statement that we wanted to share is dedicated to helping others preserve capital foremost. So hard-earned money that you and our friends and family and strangers that we meet have made, we want to make sure that we preserve that. Also preserve it with inflation happening. We want to grow our wealth together. We want to create passive income streams so that you're not reliant solely on selling, that you have other income streams coming in. And educate so that you can learn how to do this yourself, and also so that you can teach other people how to do it. And then we do all that while we're providing safe, clean, and enriched communities for our residents around the country. So Aaron and I have walked some really nasty buildings with people taking apart car engines and motor oil and in their units, and flickering lights and mold and people packed into these places, and we say, wow, we could really go in and add value to these for the residents living there, as well as create passive income for our investors all around the country. So that is something that we're passionate about as well. And before we get into choosing the market, I wanted to share, I'm going to go through it really quickly, and this is something that we can share to the email list. I think people have signed up. If not, you could give us emails and I'll share, but this is an example of the deal that we did. So I wanted to go through really quickly, if that's all right. We don't have to go through in depth. Some disclaimers. Here's the team. This is our boots on the ground partner. So we're going to go into that later, but he lives in Tampa. This was a building in Tampa that we bought in St. Petersburg. So before, I used to think, how can I ever buy this building? This is an 88 unit apartment building that costs $16 million. Only Jeff Bezos and Elon Musk and those kind of people, men and women, Oprah, have the kind of money to buy that kind of stuff, right? Well, like Aaron said, what we do is we raise capital and we crowdfund essentially, but through a 506B and a 506C exemption from the SEC in filing. They are securities, because what we are doing is we're raising money and we are passively giving investments to investors. I guess also in the spirit of showing this, I should say in one of the disclaimers that Aaron and I are not lawyers, we're not accountants, we're not financial advisors. This is educational, but we spent a lot of time and money and energy to learn this. So, learn from us and then talk to your own appropriate professionals. I should start with that.
The same kind of thing. We have lawyers that look at everything. We have an accountant that does everything. We are just I think about we are the quarterback of it. And we bring the right pieces into place so that we can get it across the finish.
So part of what we're going to go into is choosing the market and why we like St. Petersburg and Tampa. And then later on, we're going to show you how you can create this same slideshow, which we did, and why we liked this building and how we were able to, we're going to take rents, as you can see right here, from 900 average to close to 2,000 average over the course of our hold. And goes into some of the comparables of why we like it, some of the rent comparables, sale comps, as you know, the business plan of what we're going to do, and how we're going to turn this into a beautiful place, some of the existing photos of what it is, some of the neighboring properties, what they look like, some of our underwriting. And I wanted to give a broad overview of what we're talking about. And a lot of this stuff might go over your head right now with these numbers, but we'll dig into these through the weeks as we go. and how we're able to decide if this is a good deal or not a good deal. And then some of the structure that Aaron had said. So typically what we do is we find the building, we set up multiple LLCs, an LLC that buys it, and then the LLC that the owners are in. And typically, every deal is different, but in this deal right here, you can see that 70% of the money, 70% of the LLC was the limited partner, and that is the money that's needed to purchase it. So for this deal, it was about $5.5 million, and that was 70%. Then 30% is us, you could say the sweat equity, the general partnership, and that is for finding the deal, for signing on the loan, for doing the asset management and operating the business plan, for doing all the due diligence, setting up the LLCs, raising the capital, etc. Now, before we as the 30% make any money, the 70% makes 7% a year. That's called a preferred return. And then the minimum investment into that. So it's different than a REIT. A lot of times people ask me, oh, it's like a REIT. Well, the big difference is with the REIT, which I've owned, you could get monthly or quarterly dividends, right? And you can get some passive income that way, but you don't really know what they're buying, right? If you invest in these REITs on the stock market. Now this, you saw the building. I already showed you up here what the building is and where it is. So you could fly out to Tampa and you say, okay, I know what building it is. You could say, I want to buy that or I don't want to buy that, as far as the limited partners are, right? And another big thing is that when we do a refinance, a cash out refinance, you actually are an owner of the building in that 70%. So you get refinance money from that. And then when we sell it, you get a chunk of the sale as well, your percentage, as well as the passive income from the returns. Additionally, you get the advantage, especially being a real estate professional, of the tax benefits and depreciation. And we'll go into all this stuff later. I just really wanted to do a broad overview before Aaron kind of takes over on the slides. And this, again, it shows you the purchase price. It was $16 million building. When we bought it during the appraisal, it appraised for $18 million. And we got a $700,000 credit in escrow. So it was a really, really, really good deal. And we'll go into in this course how we were able to find that deal, how we were able to know it was a good deal, and why we like the market. But it shows that if you put $100,000 in that deal, I think it shows it right here, at the end of the hold, which is 5 to 7 years, your 100,000 would go into $270,000 total. And this would, as a passive, so you're putting the money into it and you're holding, and you're continuing to sell in LA, and that money's multiplying for you. I know I'm going really fast. I want to get to why we chose the market and liked it. But anything you want to add, Aaron?
No, we'll throughout this course, we'll also show you we'll do one day where we literally break this whole thing down, and we'll send you a copy of this. If you want a copy of the deck, we'll send it to you. But we'll show you how and why we do all of it. We're going to go through the underwriting, we're going to go through the market, we're going to go through how to actually raise money, literally everything we do. Yeah, that's it. I know he just kind of like threw it all at you, but that's an overview of what you're going to be able to do theoretically at the end of this year.
Yeah, and I would say, to add on to that, that our goal, so we as realtors and investors, we invest in this 70%. So we sell houses in LA and we take that money and we put it into this 70% so that our money is working for us in the investment. Then we also do the active side as the 30%. So if you guys want to learn how to do the 30%, that's what we want to teach you how to do. And if you say, no, this is too much work, you could invest in the 70% and you could do both. And to top that off, before you invest your hard-earned money into someone's deal, we want to teach you why it's a good deal or why it's not a good deal, so that you have more confidence in taking 25, 50 grand. This one was 75 grand minimum, and putting it into someone else's deal. So you say, okay, I'm confident this is, and you're going to go in with the tool in your tool belt.
Yeah, that's exactly right. We'll teach you how to look at it so that you can confidently move forward with whatever you want to move forward with.
But but the big, I know I went really fast. The big thing I want to make sure you understand is that we take the LLC, we buy it in the LLC, and we divvy up, passive investors that are investing their money so that we collectively can buy bigger buildings. And the advantage to that in an 88 unit is, you saw at 16 million, we'll be able to double the value of that to 32 million. And if two tenants are gone, we're still 90+%, 95% plus occupied. whereas a 10 unit, we're 80% occupied. So the economies of scale in these larger buildings, for example, our property management's like less than 3%, because it's so big. So we are able to buy those together through that LLC. So anyway, sorry, go ahead, Aaron.
I was gonna say, let's dive into the market and how we pick that. This kind of goes over exactly what we're gonna cover throughout this course. I guess the first thing we're gonna do is how to pick the market, how to underwrite a deal, different formulas we use, understanding market cycles and where we're at, how to raise private money, how to create a credibility book and a pitch deck, how to network to find investors and partners, how to speak to brokers and get them to send you off markets, because it's a little bit different than in residential real estate, which I'm sure most of you, if not all of you, that's what we do. Who you need to find on your team, especially when you're investing out of state, because some people will invest here, some people will go out of state. What a sponsor is, what you need to know, how to find them, where the best opportunities are without using a broker and how to find those, deal structures we talked about, and then just like how to set goals for yourself to make it like, this is attainable, I'm going to be able to do this. And this is all stuff that Devin and I went through. So we've like learned it all, we soaked it all in, put it into effect for 2 years, and now it's like, okay, we need to spread this out because we grew up in modest homes, neither one of us really came from money. So we want to share this wisdom because this is the fastest way to retirement. It's the real estate. That's why you're all in here. You all know that. So how can we actually get you to that level? Anything to touch on that, Dev?
Yeah, you skipped how to create the winning mindset, which might be the most important thing in sales or investing. A lot of you guys know that, but similar to sales, I mean, there's a lot of parallels in what we have to do for this, right? You probably already saw that on the list of sourcing off-market deals, connecting with brokers, building partnerships to be able to do it. And I can't tell you how, I mean, in the last couple months, we've been in 4 escrows for deals where Aaron flew to Northwest Arkansas, I flew to North Carolina. We're in deals in Scottsdale, Arizona, and San Francisco. And then we underwrote countless and dozens of deals that haven't panned out. So those deals I just said did not work out because of due diligence things and financing terms. And so the winning mindset is humongous, right? That and you had skipped over it. So I wanted to make sure to touch on that because when you work 6 months or 9 months for a listing lead in residential or multifamily in LA and they list with somebody else, it's a punch in the gut, right? Well, we can feel that. We sympathize with you, and it can be similar to this. But the goal setting and the persistency and getting like 1% better every day is humongous in this because I just said it. 5 years ago, we were touring in a minivan playing music around the country, and now you saw that we have 388 units and $45 million portfolio. And it didn't always like fall into our laps, right? There was a lot of gut punches along the way. So yeah.
We underwrite usually somewhere between like 80 and 100 deals before you find one that actually works. So just know that there's a lot. And like you said, you guys kind of all have an advantage already because you've been through inspections on multiple homes. Same thing with an apartment building. Usually there's one roof, there's one foundation, but there's a ton of plumbing and a ton of electrical. So you go through unit by unit and check everything. So we've had to cancel a couple of deals because sellers wouldn't give us the credits we needed because of the things we found in escrow.
Yeah, because to tap onto that too, because we're responsible, as I said, for preserving and growing our investors' wealth. So sometimes the deals that we really liked and like maybe they would have worked out, maybe they wouldn't have, it would be okay for like me and Aaron and another partner. But when you have 30 people's savings going into it, you have to make sure that you're super, super confident in those. Yeah. So here it is, beautiful USA right here.
Yeah. So basically, how do we decide where we want to be? We're all local to California, but there's a lot of things that go into little like metrics and why we choose where we choose. The main things we're looking at are job growth, population growth, diverse jobs, the tenant landlord laws, rent growth, unemployment, and low crime. And this is just to also put this in your world, like this is for what Devin and I do. And there's a million ways to make money in real estate. There's a million ways to do it in multifamily. This is specifically what we do. And we target value add, like C and B class properties, C and B class areas and just kind of take them up to the next level. We're not looking for Section 8, really. We're not looking for like the AA class, brand new constructions. We like working class. That's our bread and butter.
Yeah, that's a very good point. So just to make sure everyone's aware, I mean, you probably are as real estate professionals, but A class meaning like a 2022, 2023 building that has, like we toured some in Scottsdale, it had like free kombucha and cold brew coffee when you're walking it, right? And it was very LA actually. And B class meaning like a nice place, maybe within the last 10, 20 years that has some amenities, a pool. C class is where we're getting into like 70s, 80s buildings that really need some work and some love, but it still has a nice school teachers and mailman and landscapers and working class. Like Aaron said, blue collar. Ideally, we're looking for 80s buildings, but we'll get into that in another class. But yeah, I'll go to the next slide.
Cool.
Just to finish that thought, what made me want to think of that, like Aaron had said, people do make money investing in low income areas, and I mean, quote unquote war zones. They kind of said in our classes of perhaps gang and crime. And you know, we're not we do have some Section 8 properties, but I think our bread and butter and what we want to emphasize in this course is that bringing a C class building to a B class or B plus. So that's what we're teaching here.
Exactly. So finding an emerging market is like the number one thing. You always want to be ahead of the curve. So how do we do that? We look for job growth that's more than 2% year over year. We look for strong government leadership. We look for median income growth, major interstates, big box stores, health hubs, shopping centers, airports, goods and services, transportation, and then at a minimum 100,000 or more people. We don't want to be in a small little place because one thing can go wrong and the whole area gets empty. And you look for like colleges, hospitals, military jobs, government jobs, things like that. So usually it's like the primary and tertiary markets of a state. So like you think about Arizona, there are probably 3 cities that we would invest in. Can you name the 3? Scottsdale, which is part of Phoenix. Tempe is also part of Phoenix. What other metros? Flagstaff and Tucson. Those are probably the 3 that we would invest in. I'm not trying to go anywhere outside of that. Phoenix is huge. It's enormous. And it has Tempe. It has all that. Scottsdale, everything. Cool.
So,
anything else?
Yeah, I would say, I mean, the 100,000 plus, look, I'm in Dallas and I'm meeting up with partners of ours and friends of ours for the last 2-3 years that we've made and developed relationships with, who live in Idaho, and they might invest in a smaller town because they live there and they're boots on the ground. And maybe some of you are from Kansas or I should say smaller parts of the country, and you know and trust the people there and what's going on. We are designing this because you guys are in California with us. And so what we're saying is what we've been taught to invest out of state. These are ways to mitigate the risk and be successful. And so that is what is one of our metrics, being in LA, investing out of state. And then, yeah, obviously the last is, and we'll get into this more, but colleges, hospitals, military, government jobs, stable jobs and employers, which keep people there, and it keeps job growth, which keeps rent growth, because people need to make money. So we're going to hammer down a lot on jobs.
Yeah, so when we're looking at the key metrics, it's these things right here that we have listed out, and we'll go into detail, I think, on each one of them. But it's job growth, it's population size, population growth, unemployment, the vacancy rate, major employers, median income, the crime rate, tenant laws, major employers is on there twice, rent growth year over year, affordability. Like affordability is basically rent versus buy. Like how much does it cost to buy a house, like the median house? And how much is rent? Where do you want to get the rent to, and how do they compare? And then travel time, because how fast can you get there if something goes wrong, right? And then taxes, we'll talk about, and the household size. You want to go to the next one?
Yes.
I like having him just to be able to like hit next. So yeah, so job growth. We want 2% year over year. That's like a standard metric that we look at all the time. We look at unemployment rate to be under 5%. And we want the median income to have 30% growth since 2000. So over the last 20 years, it is significantly growing. And these are some websites right here. We'll get to a little bit more in detail on those, where we can find all of this information. So there's citydata.com, there's BLS, which is the Bureau of Labor Statistics, and then bestplaces.net.
Yeah, this is awesome. And like I said before, I feel free to take notes or take pictures, but if you guys want, we can email you this with all the links.
Yeah. It's
so,
all, it's the whole thing, everything we show you is for you guys. We actually also have a spreadsheet that we'll send to you, which is literally how we evaluate it, left and right, everything.
yep.
You want to do this one?
No, go ahead. Hold on 1 second. I'm gonna mute myself, but oh shoot, I just muted you. Will you guys unmute? Can you guys still hear me? I accidentally muted that computer.
We need you to share the screen.
I was trying to let you know I couldn't hear you. Sorry, guys. I'm a better real estate investor than I am a techie.
That's a fact. Yes. Okay, so diverse jobs. What we're looking for is multiple big employers and corporate jobs. So like Fortune 500 companies. You want like Costco's. You want like government jobs. Like if this like a state capital and they have all of this government jobs for that state, that's great. And you also want diverse sectors. So like I always say, you want to be careful where you invest in Texas, because if the economy is fully invested in oil and oil prices go down, or for some reason the plant shuts down or something, the whole city's upside down, right? And you don't want to put yourself in that situation. You want to be very diverse. So you want tech, you want oil, manufacturing, you want auto, you want healthcare, you want government jobs, like the whole thing. You want universities if you can find them, the government jobs. Military bases are great because military bases aren't going anywhere. And hospitals usually same thing, they're not going anywhere. And again, we'll have all these links in it, but honestly, you'd be surprised how much information you can find just using Google if you know what you're looking for. It's so easy.
Yeah, and I was gonna say that I went to Syracuse University in upstate New York, and Carrier air conditioning was big, was humongous there. And when it went out of business, it really hit the economy. And you could see it firsthand, or I could see it firsthand being there, how many people were let go and what happened to people leaving, and then the increase in crime, and then not having enough jobs for people. So that's why we keep hammering home jobs is the most important thing. I can't remember the stat or what we learned, but it was something like, for every white collar job of it creates like 5 more jobs. For example, like if a healthcare company comes in, then they have to put a Chipotle and they have to build it and they have to put in gas station, so for every major corporate Fortune 500 company, it creates so many other jobs in retail and building houses, for example. But that keeps us safe as investors and also for our rent growth, which we want, obviously. So I think this all makes sense, but I wanted to show now on this slide, we wanted to provide like as much value as possible in putting this together. And literally on the plane this morning, I was trying to add more slides so that you guys we're giving everything away, right? Like stuff that obviously took us time and energy and money to learn. But I think it's really awesome. So what we look for, 12-month job growth percentage, right? So if this is going down, this is bad because, like I just said, people are losing their jobs there and people will leave. So I think this is even a clickable link. But you will be able to look right here. It's amazing once you have the information in front of you. You can look up, like Aaron had said, Flagstaff. Boom. Why did Aaron say he liked Flagstaff? 4.65% jobs change in the last 12 months. And our metric was 2% for cities over 1 million, or 1.5 if it's a big city over 1 million, 2% for anything else, right? So Flagstaff passes that one test. Then you could scroll down to, I don't know, Dalton, Georgia, 0.6, not looking as good, right? But McAllen, Texas, boom, man, I have to go check that out while I'm here, right? That's looking really good. So you'll be able to use these tools to do work. we're going to give you so much information and so many metrics that we've learned. Sometimes we've invested in places where not all of them are achieved. For example, maybe the job growth is like 1.5%, but we love the sub market and we love the partner and we trust them and we've flown there. So these are kind of rules of thumb, I would say, right? So you want to take everything that we teach you and that you learn on your own, and then talk to the boots on the ground partners and make sure you fly there as well. Anything else you want to add on that, Aaron?
No, I think that's right. And you can, on this website, you can actually sort by column, so you can look, okay, what cities have had the most job growth in the last year. So like they make it, it's very easy once you know what you're looking for.
Oh yeah, there you go. Sorry.
So yeah, you can see negative job growth. Things you want to avoid: stagnancy, negative job growth, anything like that. The one thing that this won't tell you is this won't tell you specifically what the populations are. So you'll have to like, that's why we're going to give you guys like a spreadsheet. So it's like, okay, this is this, and you can figure it all out.
Damn, look at that, LA, killing it.
Yeah.
That's why we're saying it's only one metric, right? Okay.
Yeah. You have a question?
Yeah, I mean, out of those metrics, so let's say there are 10 metrics.
Yeah.
I mean, are you trying to hit, I don't think you're going to go 10 out of 10 every time.
I try for 10 out of 10.
Right, so at what point are you like, okay, this is good, or certain metrics more important than others?
So I think job growth and population growth are the two most important for me personally. Because if those two things are happening, people are moving there, and that's just a matter of going to the market and finding the areas that are changing quickly, right? That's how you find like an emerging neighborhood. Look for trains, look for, you know, a lot of infill stuff that's coming up. But those are probably the two most important to me.
I just wanted, yeah, I was gonna show you real quick. So we invested in Tampa. That was the building I started with, right? 88 units, 16 million that we're doing. Look at this right here, 5% in Tampa, Florida. Then I'm gonna show you. This is kind of cool that I'm on Zoom because I can do this actually. Oh, now you guys know exactly where I am. United Gates Apartments. This is where we invested. Right across the bay here is, what's that say? Air Force Base. So one of the stable things that we liked was the military base right across. Then there's tons of restaurants and jobs. Look, this is another thing that we said of picking a market. Trader Joe's. Trader Joe's and Chick-fil-A hire way smarter people than Aaron and I to pick where to put their stores. And our building is right up, we lost it now, but it's right up here down the road from Trader Joe's and Chick-fil-A. So we're saying, okay, they're investing there. That's where we want us to get into as well.
It's also a lot easier to raise money when you can point to things that people here recognize and know. So if there's a Whole Foods like 2 miles from it, great, mention that. People love Whole Foods. Same thing with Trader Joe's, same thing with Chick-fil-A. Find the places that are growing and like other businesses that are way smarter than us that are moving in.
Then again, the building is up here, right? All the hospitals in the area for all the jobs that are coming in. And one of the things that we might explore is taking some of the units and furnishing them to do travel nurses via furnish finders to increase the NOI even more. But I didn't answer your question. So I think jobs is, from what we've heard, like the most important thing, because naturally, if there are jobs, people will go to where there are jobs. Now, that being said, you're going to say, well, wait a second, you just showed me that LA was 4.5% or something, right? So why aren't you investing in LA? Well, there's other metrics. And by the way, we do submit LOIs in LA. Because we know LA so much and we know the sub-markets, we would invest in LA before we invested in New York City, for example, because the tenant laws, as you guys are all aware of, I'm sure, are so strict in California and New York that it can be very difficult. But we know LA, and we could be really hands-on in which tenants we selected and who we got into our buildings. So that's why I say these are kind of guidelines. We do know people that invest in New York and have done so very successfully because they live there. But yeah, does that help answer your question?
I think I get it.
Okay, cool.
Next thing we talked about briefly is population growth. Metrics that we look at for that. So if the city is under 250,000, we want 30% growth since the year 2000. If it's between 250,000 and 1 million, we want more than 20% growth since the year 2000, and so on and so forth. So like a big city, 2 million plus, you only really need like 10% growth. You just want to see that it's still going, it's still growing. And you can get this data. This data is from Google. Okay, he's doing population.
Yo creo que vas a tener que estar tomando fotografías de los slides. Y bueno, para que lo veamos. Hay que dejar las llaves porque si no vamos.
Can you mute that person?
Yeah.
There you go.
Nice. I don't know that. You want to go back to sharing that?
Yes, someone just joined us.
Cool.
So somebody pick a city.
Yeah. Big city. Any city.
Austin, Texas.
Austin, Texas.
Oops. So Austin, Texas population. So it'll tell you like through here where it is and where it's gone since 2000, right? So again, you can 675 to 2021. So then you'd be able to tell the percentage that it grew. Oh, that's awesome. It goes to 2021 now. So when we started doing this, it only went to like 2018. I think that's why our note said that. Or 2017, yeah.
But you get that. And then again, you can use Google very easily, or there's two more references down here that will show you guys. Want to go to the next one?
Sure. Yeah. And I think, I mean, again, you'll get this, but it kind of helps you protect you again, because if they're smaller cities, you want to make sure that they're like super booming, that a ton of people are going there. Where if they're already, I mean, Austin, the other thing is that sometimes you'll say, well, wait a second, Austin, like the full MSA, right? Like I grew up in Portland, so the city of Portland is not as big as the full MSA, or like LA County versus LA City. So you can adjust that to if you're investing in a place. I mean, we were looking at a building, I think in like North Austin, that was just outside of the city. So it might not even, you can see the lines here have been like the city of Austin, somewhere like up in here. So obviously like the city versus the entire area surrounding it, the metro.
Yeah.
Further anticipate, the vitamin of the rate, how do you anticipate what sectors would be most affected by that?
So as long as it's diverse and we see people moving there, we're obviously going into a recession and unemployment will become a factor, but you just want to avoid places where there's like a very small, narrow focus of jobs. Like if the jobs are diverse and population is growing, the market will over time stabilize and continue to grow. And that's why you look at the last like 20 years. It's not just like the last year or two. You're looking at the trend over time.
Right.
And as long as you can see it's still happening, even if it's leveling off, it's still kind of projecting upwards. People are moving there. You just kind of like want to make sure it's diverse and that hedges your bet. Yeah. If you hear about, also you can Google like news alerts and like look at like certain cities and see if things are developing or if like plants are shutting down, or like look for specific like employers themselves and see how those businesses are doing. There's a lot of research that goes into all of it. Does that answer your question? Yeah. Okay. Yeah, no problem. Other things that we look at.
I think real quick to tap, I think I heard the question, but some of the things that we do to prevent like a hedge against a recession, we'll teach in later lessons in how to analyze in our underwriting calculators, like what if rents go down or what if rents stay the same and we put all this money into it, and what if the cap rates go up? And then we'll be able to say, okay, instead of doubling your money, you'll still make 1.25%, 125% of your money. So we'll touch on that as well. This is specifically the market, but I wanted to make sure that came across as well. And then there was something else I want to say. Oh, and we're about to talk about it right now, but affordability of renting versus buying is another big thing in picking the market, which has to do with the recession as well. Go ahead, Aaron, you could talk through that.
Yeah, so other things we're looking at is like the crime rate, and citydata.com has like a whole chart, and it'll go year by year, and it'll show you they basically for violent crimes, it'll have a number to it, and that's where, yeah, that's where the 500 comes from. But this literally will show you exactly where to go, exactly what to do.
So I
So
wanted,
type-
there you go, yeah. Oh, I gotta pick a city first.
wait. Any other city?
Baltimore.
Baltimore. Baltimore.
So
you
what we're,
scroll-
yeah,
It has meeting and income census information, and this chart right here is the crime. Crime rates for Baltimore year over year.
so you
So
see
it
down
shows-
here,
Yeah,
and we even spelled it out for you. Like Aaron and I are systematic people. We try to be. And so we tried to write it out for you to have a system so that when you're doing this, you're not scratching your head, but it literally tells you bottom of the table, far right column is under 5 and shows the increase or decrease here, right? So in the slideshow, you'll be able to go through and do this as well.
Yeah.
So crime is on the bottom, and we are looking for under 500. So it starts at 775 and it goes down, but then it shoots back up a little bit to the 800s. In 2019, 800. So Baltimore has some higher crime rates.
yeah. We would probably avoid Baltimore personally. Some people would not. That's fine. But this, for what we're looking at, this is the trends that we're looking at. Also, the fact that it's spiked also is kind of like a red flag for me. Like, okay, what's going on? I mean, everybody knows, everybody hears about Baltimore in the news. It's not the safest area to be in. And there are, I'm sure, great places in Baltimore to invest. But this, for me, right away, puts a red flag. So I would dig a little bit deeper if I wanted to jump into Baltimore. Yeah, go ahead.
Yeah, yeah.
Good. Yeah, definitely. But again, it's we are looking at them, but it's looking at the whole holistic view. Like,
So are you guys engaging with numbers to say?
so I proceed with caution. That's what I would say to that. Again, it comes down to diverse jobs. I know, like, if there hasn't been steady growth, if it was like flat and then suddenly a huge boom, I would be very cautious. I would go visit that market. I would see what's going on there and make an educated decision for yourself on that. I would be a little nervous about that personally. But again, I tell Devin this all the time when we tell our investors, we're probably more conservative than most people will be. But that's because my parents' retirement is invested with us. My aunt, you know what I mean? Like family, friends, all of that. So it's the most important thing is the capital preservation.
And we're also trying to give you tools to narrow down, because you could point at a map in the US and say, okay, I've heard that Boise is good, so I'm going to fly up there and check it out. But it gets expensive quickly, right? So if you have some metrics that you can look at to narrow these down, then, which we'll talk about later, the next step is going to visit the market. So, I mean, there's a reason that I'm in Dallas and that Aaron and I have flown all over the place to get to know people. And we'll talk about that in building your team. But this can help. So Phoenix was one of the markets that we really liked. And you can see that the crime rate is under 500. Now Phoenix got really expensive and super competitive, and we've tried to purchase there and we were under contract and had to cancel, but we do like a lot of the metrics there from a choosing the market standpoint.
Yeah.
That was back to
yeah. So again, we talked about affordability. Like you can just go on Zillow and like a neighborhood and be like, how much does the median house cost? And then you can calculate what's that principal interest tax, what's that monthly payment look like? And then what are the rents in the area? Are they comparable, or is there a big gap between the average house and where rents are? Because that difference is your possible rent growth, right? If it's equal, why is somebody renting when they can just buy something? So you want to see a big gap. So that's one of the things we look at, and that's pretty easy to find. Yeah, go ahead.
Like, question, you guys are like going to different states. How do you figure out what the taxes are? Do you contact another agent to ask them that, or?
Yes.
Or is it public records?
It's most of it's public records. You can just find it on Google. You can look at like the tenant laws, landlord laws, taxes, look at sales tax, income tax, property taxes, all that. We always, when we're calculating, when we underwrite deals, we always call the actual county assessor, the tax assessor.
I was just gonna say, yeah.
Yeah, have them talk you through how to calculate your taxes. And there's somebody there that will do it every time because, oh my God, I get to talk to a human. Because they just sit there and look at the computer all day. And
So
they're very, very,
yeah. Oh yeah, I was gonna say again, Phoenix was a market that we liked and did a ton of work in, right? So I just looked up. You could even type in Google, what county is Phoenix in, right? And they'll say Maricopa, and then you say Maricopa County Assessor's Office, and you Google it, and then you could same as LA, right? You could put in the parcel, and you can get an idea of what the taxes were. But it's even better to call the numbers on here. And we've talked to these people literally, and we say, hey, how are the taxes assessed in Maricopa County? Is it when you purchase the building, or is it reassessed? And then they'll talk you through it. And then you'll say to the broker, hey, I see in your offering memorandum that taxes are this, but I just got off the phone with the assessor that it's this. I mean, maybe you keep that in your back pocket for negotiations later. But that's a very, very good question, because property taxes can kill deals really fast.
yeah. There's a deal in Cleveland that we are in PSA conversations with, like purchase and sales agreement. And the only reason this deal works is because in Cleveland, there's a 15-year tax abatement for properties that have a certain amount of renovation going into it. So that means no property tax for 15 years. The only reason that deal works. And we wouldn't have known that. We actually got that information from the broker. But as soon as they told us that, we were like, okay, I'm going to call the tax assessor. I'm going to find out everything about this. But there are little things like that you won't find until you like focus in on a market and ask the right questions and talk to the people that's their job. And everybody is there to help you. Every single one of these people that you contact is a resource for you. Cool.
And before we move off of that, so you might be sitting there thinking, wait a second, like what's the metrics of Cleveland, right? So some of those things that we talk about aren't met for Cleveland. However, that's a really good point, because we have a partner there who already has buildings there, and he has had success there. And so that's why I say everything is kind of a grain of salt. That is a guidance and a rule of thumb. But if you have people who are doing it successfully, and this building, for example, is like right across the street from a really, really good neighborhood that it's spreading into that neighborhood. So it's got really good growth in that submarket of Cleveland. So you have to look at a wide lens and then zoom more narrow. So it was worth the time for us to underwrite the deal and submit a letter of intent and LOI to potentially pursue it. So now we're in the due diligence phase.
Yeah, the other thing is rent growth. We want to see consistently. We want to see the tenant laws. We want to Google them, find out how fast can you evict somebody if they don't pay. Most of the country, it's like 30 days. California, not the case, which is one of the major deterrents. And then taxes, like you talked about, income tax, property tax, all of those things.
And the tenant laws, again, we'll talk about this in building your team in a later lesson. But and guys, this is a lot of work. Like you see, I mean, we're not just closing our eyes and buying a $16 million building, right? Especially with other people's money. But you get on the phone with the property managers who are local. So you can go on LoopNet and you find the brokers who are selling buildings, and then you call them and you say, hey, who's your favorite property manager? And you get a list of 5 property managers, and you call them and you ask them, what are the tenant laws? Because they're the people that are actually evicting people every day. So that's how you're able to build out your spreadsheet of the rules there. You can Google it as well, but you could call the people and build a relationship with them. We went through this for the crime. This is another very important metric that once you get to the broad area of the city, especially when you have someone sends you a deal, a broker sends you a deal and they say, I love this area. You'll be able to take rents from 500 to 800. And then you look at the median household income for that specific census tract, and you say, wait a second, people don't make enough money for me to actually increase rents to that. They won't be able to actually afford it in that area. So from the broad market stance, you want 30% growth in income for the city. And this explains to you again how to do it. And then one of our mentors had said that you never want to go below 35K for the whole area. Now, there are certain deals in areas where it does make sense, but similar to LA, a lot of you probably know that if you have rent for $1,000 a month, we want our residents to be making $3,000 a month at least. So 3 times their earnings. the rent is 1/3 of their earnings. So they're making 3 times that. So it would be $36,000 a year that we want them to be making. So that is a metric that we use. And then this tool is really cool. This is another awesome hack that we've learned. This is how you can learn. I mean, I don't know if somebody wants to give me an address. What is? Well,
What's the address for that?
here,
Yeah, just 2 screens. Okay. So this is the address of the building we bought in Florida. So you can literally type it in into this website, which we will give you. And then
and up here you switch it to 2022 because 2023 hasn't come out yet, probably.
Similar to like Zemas.
But it's similar to Zemas, but it's census information for the whole country.
What's going on?
So-
There we go.
So then right there, you click on this where it says census demographic information. And it will tell you the tracked income in 2020 was 67,000. And that tracked is just, you zoom out a little bit now,
Yeah, that's as far as I can go.
no, out.
Oh, sorry.
And so the tract is literally from this block, you can see it's just from here to here and from there to there. So it's not even the zip code, it's more granular than zip code, more granular than the neighborhood.
What's the website?
We'll give it to you. It's like geomap.ffIEC.gov, but we'll give it to you.
And you don't look at just that side.
So we look at this first, and then we look at what surrounds it. So ideally, we want to see the area that it's in. You want to see some area that's like really, really good, like maybe 100,000, and then yours is 60, and then like maybe the ones around it are like 60, 70. You want to look and see the whole area is good. But there are situations where, say, this one will be 100, this one will be 70, this will be like 20. And then do you want to invest next to somewhere that the median income is like 20,000? That's a question for you. Probably if you have found the property already, the only time that you're going here is once you already have the property figured out. And then when you're going to go visit the property, that's when you would like, okay, I'm going to drive across that street and see what changes. And then make the decision for yourself, do I want to invest there?
So, and to go back to what I was saying before, we want to bring the rents from 900 to 2,000. So 2,000 times 3, we want every person to be making 6,000 a month in that tract. Times 12 is 72,000 a year. Well, the estimated tract median family income for 2022 is 77,000. So we're saying, oh, actually, we're good. They think that people are going to be making 75 to 80,000 a year in this specific neighborhood of St. Petersburg, Florida. So we felt confident in that.
And again, you wouldn't really go to this website until you have a property that you're thinking about, because it's super granular.
Yeah, yeah, exactly. That's for once you have I guess I kind of jumped the gun. I was just excited to share that. But you can find the median household income on city data and other Google searches. City data right here, which is another killer website. And then this is one that I added. I don't even talk to Aaron about this yet, but this was important to me too. Like, well, I was so excited about the Tampa deal because my partner of 7 years, her mom lives there, and I've flown out there a bunch of times already. So I'm like, okay, I like the market. I go out there already. Wouldn't it be awesome every Thanksgiving to write off the trip because I'm going out for business now to check out my buildings on top of seeing family, right? And so I can get most often a direct flight, a travel time. Yeah, it's all the way across the country, but it's easy to get there. I'm going to the location already, and I have people in my immediate life from college, from Syracuse, that lived in New York City, who are now moving to Florida. So while I don't think I want to live in Florida myself, I like California and LA. That's why I sell houses and live here. But people do like there. And so there's jobs and there's population and the rent's going up. And I'm going there anyway multiple times a year. So those are factors that I considered in wanting to invest in that building. Now, there are some places like we've gone to Knoxville. And for whatever reason, I'm pretty sure like you have to make 2 layovers to get to Knoxville every time we've flown there. So
Yeah.
while Knoxville's a great market and we have partners that invest there, we haven't done that. And again, if there was a killer deal, I'm sure we would do it. But before we bought the Tampa building, I flew out there 3 times and met Alex, our partner, to do things like check, well, and we'll get into that, but I checked the area, I checked where the jobs were. I walked, I pretended that I was a tenant moving there, and I walked our building and I walked the neighboring buildings to say, would I actually, Devin, pay $2,000 to live here if we fix it up? And so there's the time and energy and effort that it takes to do that. It was easy to get there, and I was doing it already. Anything else you want to add to that, Aaron?
Yeah, no, I mean, this is super important, because if you own a building there, you are going to go visit it. So like Devin and I, we're outdoorsy people. He skis, I snowboard. So when we were first looking for a market, we were like, well, wouldn't it be awesome to have it be a place that we could go and do ski trips? So first place we looked was Reno, Nevada. There's like Tahoe's right there. It'd be perfect. We looked at it. All the metrics were there, but one of the things we didn't choose to work there because the barrier to entry, the price per unit was very high. And also there just wasn't a lot of inventory. So things didn't change hands very often. We underwrote deals there and it just didn't pan out. So we moved to the next one. But like that was the first thing we thought was, oh great, wouldn't it be awesome to go for a week, see the buildings, snowboard. So find places where you have family, where you like to visit, all that stuff. That's great.
So on top of all the numbers and the metrics, there's a little sense, sounds like to me, by walking through the property, there's a little bit of a gut.
Yeah.
Gut feeling that you have to have as well.
Definitely.
And does that just come later on, right? Once you've done the metrics, now you're like, what is my gut telling me?
Yeah, exactly. Once you're in the market, because you won't buy something. I mean, some people do, but I wouldn't recommend buying something without physically walking it. And you'll get a feeling when you're there of whether or not you want to move forward with it. Yeah. And I mean, you can't really put a measurement to that. It's kind of the same way when like a first time home buyer walks into the house that they write an offer on. They just like immediately they know,
And there are ways before you fly out there, and again, we're kind of getting long here, but like, for example, in Cleveland, we met the property manager and I had the property manager go to the building and do a FaceTime tour with me. So we saw the street and we saw the whole building, just like you guys probably do for out-of-state home buyers. So I was looking at it, just saying, wait a second, where's the laundry rooms? We're not buying a place, so there were things that are like, all right, before we even fly out there, I want to check off that this place has laundry in it. So yeah, here are some other resources. Actually, Aaron, I was going to say that we didn't have it on there, but CoStar, we should add this to our presentation for next time. You can get reports and also look on like Marcus and Millichap yearly reports of how many buildings traded. Because one of the big problems in Boise, which was also a market that we liked at first glance, being on the West Coast, hardly anything sold. So there was no inventory. So before we poured a whole bunch of time and effort into going to build relationships and traveling there, we said, actually, you know what, we're going to cross this off the list because there was nothing selling.
Yeah, I think it was something like 30 buildings sold in the last year. And 30 is not enough to warrant your time and energy. Whereas Phoenix, I think it was like 250. So we were like, oh, okay. Yeah, we're going to go look there. Yeah. And then, so that's kind of like the whole thing. We kind of went a little bit long. Do you guys still have time? Yeah. Okay. So one of the things we were going to do is, do you want to look at a market right now with us? Do you want to just like pick one and let's just run through the things?
Sure.
Arizona, which city in Arizona? Tucson. All right, sweet. Devin, you want to lead this? You want to pull up that? You want to pull up that sheet that we made?
Yeah, I stopped sharing so you can't see all the dozens of unread emails before I pull that up. Did you make a one for this?
Yeah, it's in the folder.
Got it.
And we'll send you this sheet too. If you guys want it. I think, did Rob, you have everybody's emails? Or yeah, if you get Rob your emails, send it over, he'll send it to us and we'll send you all this stuff. So you'll just have it all for yourself. I love that Bonnie is still just watching, hanging out.
Yeah, before we do this, just to finish out so I can close that screen. Thanks for bearing with me.
I'm very impressed with your technology skills today,
Yeah,
Devin.
it took me 3 years of pandemic, but I know how to use Zoom finally. So this is like another high snapshot of what we are On-Site Equity, Aaron and I. That is our company for investing, and so this is like a snapshot of what we do in locating the market, which we've gone through, the property itself, building the team there, touring comps, and the actual subject property, underwriting a lot of deals, which we'll get into, going through a calculator and how you input the data of the rents and the expenses that they have, and then the rents that we think we can bring it to, and the expenses property managers tell us into that. Due diligence, as you guys know from buying and selling houses, a lot of the same things, scooping the sewer lines, checking the electrical, the roofs, but also we look at the leases. So if the landlord tells you, wow, yeah, I mean, and this is a whole other class, I don't need to go into this, but there's a lot in that, shopping, loans, insurance, et cetera, more underwriting, because we take the numbers that we find and put it back into our underwriting. Then we provide investors with a deal summary, which I showed you. We do a webinar explaining why we like it. We get on calls to answer, set up all the LLCs, the legal docs with lawyers, the investment portal, and closing. And then we have to actually go to work executing the business plan and doing the asset management of the property. So this is that 30% of the LLC, to go bring it full circle to the beginning. This is the general partnership and what we do with our partners. Then what the limited partner does, and what I wanted to say, if you say, you know what, I'm making good money selling houses in LA or Cerritos, that, you know what, I want to put my money into these deals, but I don't necessarily want to run them. Well, I want you to be educated so that you pick good deals. So you would look at the deal in the webinar and the deck, and then you could underwrite the market with what we taught you. Little smiley face there, so that you know from what we taught you that you are excited about the market and the deal itself. Then you make the investment. And then it's really easy. It literally is a passive stream of income, and your wealth is growing for you. You attend quarterly calls to figure out what's going on. If you want, you read the monthly updates. You can check the year-end financials, and then you're getting ACH into your bank accounts, which we are getting quarterly from a lot of our buildings right now, which is really nice, because you forget about it, and then all of a sudden you have money coming in. Before we move on to if you guys want to take a picture of this is our contact information. If you have questions that come up, again, you can get this from Rob, or we'll send you an email, but this is us, Aaron and Devin. And then we can get into doing a market.
Cool.
Which is here.
That's Instagram and all of those things.
Oh yeah, Instagram.
Yeah, that's the one that we're most active on.
Which, by the way, is a great tool for finding more buyers and sellers in your residential sales business. Sidebar.
Yeah. So here, this is what we'll send you guys if we get your email from Rob. And this literally breaks down everything that we look at, right? And we'll send this to you so you can have it. But you can see we already have these two in here. This is literally from when we did this, I think in 2008, 17 or 18. We haven't changed. We haven't looked back at these markets. This is all that data from there. But you want to do Tucson, right? All right, so boom, put it in there. Tucson is one of the markets that we looked at and wrote several LOIs on. We're still very interested in it. So I know it's going to pass most of these. So good choice. So yeah, you can Google the population of Tucson. That's one way to do it. Or you can go to the best cities, or you can do the city data. All of those things will work.
Yeah, where's this? So you can kind of
These are all those websites are going to be great resources for you, which we will get to. You can see population. It shows you the median income, shows you the age, median home price. unemployment rate. So that unemployment rate's not great, but that's okay. We'll keep looking at it.
Yeah, so you can go ahead and fill that in while we're looking at it. I'm getting distracted here. Here we go. Unemployment, 7.4%.
That's high.
Population was 545 about.
Yeah. There is a lot of retired people. I heard somebody say that in Tucson.
Are you gonna send us?
Yeah. No problem. So what he's looking at now is, I think, rent growth over time, right?
Population
growth?
growth, yeah.
Yeah.
So five. Somebody ask a question.
No,
545 minus 487.
and this is also, keep in mind, this is Tucson, not the metro, because there are other little cities around Tucson.
How many years did you go back? Sorry.
So he went from 2000. We always
Yeah.
try to go back.
That's a really good point, actually. So that's what I was saying earlier. So the MSA, the Metropolitan Statistical Area, I'm glad you said that, is 1,058,000, right? So if you wanted to, you could even put like underneath like MSA 1,058,000.
That's real good.
So that way you'd know that is yeah, that's really good. So the city itself has grown 58,000 since 2000, according to Google, which actually is not that great. You'd say, what did I say it was? Sorry, I have too many things open now. There you go.
It's grown to about 10% since 2000.
A little bit over, because it's 487, 58,000. So, yeah, 12%. So 12% growth. So, I mean, it's a little bit of math there, but I took the new population minus the old population and then divided that number by the old population. So it's about 12% growth, which is a little bit on the low side, actually. I thought it would have been higher. But maybe the MSA is bigger.
Yep.
And then we'll go to what we were doing for job growth. So we could look at this again. Oh, actually, since I have this up, well, too many tabs open. Sorry, guys.
You're doing great.
Yeah, first time doing this on a Zoom call with people, Tucson. So we'll go down and we'll look at the crime. And the crime in 2015 and 2016 was not great, right? 510, 517, but then it's gone down 512, 477, 389. So 389, again, this is only 2019, but the trend is going down, which is good. So I could put 389 in 2019. And there are some other websites as well that we could do. The thing that we want to teach is, you, like I said before, you could point and pick at any city in the US and you could spend hours on that city, but this is a really cool first glance at it to see if you should dig deeper into it. Because what's the other website, Aaron? Crime Spot?
Crime Spot. Yeah, but that's more if you find a property that you want. You can go to Crime Spot and you can literally type in the address and it'll give you the area and you can see if there's been any violent crimes recently. And typically that's something that we steer away from. There's always gonna be burglaries, there's always gonna be like petty crime, things like that, but really just avoiding violent crime areas. That's the key.
Yep. And then I was going back into again Google, but you can do population growth trends of Tucson and saying, oh wow, look, this might give you a little bit more information as to why it only has grown 12% since 2000, because it looks like in the recession, Tucson, it was hit really hard and it went down, right? -3. But then since then it has gone up. And so you're saying, okay, so population has gone up a lot. And people are seeming to like living there and growing there. The population is growing. And then going back again to what I said before, I had friends from LA who were moving to Tucson. And so you're like, okay, I'm seeing the data online and I'm seeing that people I know, like in my real life, are going there.
So this could actually, so like every time that we underwrite a market, you can see it'll probably take a half an hour to go through and get all of this information. But you have it all here. We're gonna give this all to you. You guys, we can go through the whole thing, or do you guys have any questions that you want to ask?
Yeah, we should probably do that.
No.
'Cause I have to get going as well.
Yeah. The minimum units. So for syndications, honestly, it depends. It's more about price point. So Devin and I are open to anything over 6, but 6 units is going to most likely be a joint venture, or the 2 of us are going to buy it together. But as soon as you start getting into like the 20 plus, where the purchase prices start to go up, that's when it's like, okay, I need to syndicate. So like usually on units that are 20 or more, depending on the market, that's where syndication starts to come into play. Anything under that, we usually try to find a small group of people just to buy it with, and we all have responsibilities, we all have roles, and we do it together.
Yeah, that's a good point to point out, is that, again, anytime, from my understanding, you are offering a passive way for people to invest, it's a security. So when we do these smaller buildings, like Aaron said, like we have a 14 unit in Oklahoma, and it's only 4 of us, 4 entities that invested in it. And so we all have active roles. Some people, like, we're on the phone once a week with the property manager, and we're making decisions about the building, and we're helping file the taxes, and et cetera. These larger buildings are syndications because we offer it to people that they can passively invest and they don't have to have that active role. So it has to make sense. If you know, some of the deals have been, maybe you need $1 million to $1.5 million to buy it, but one investor is coming out of a 1031 and says, I have $1 million I need to put into that, and he or she is willing to be active in it, then that could still be a joint venture, where we do it together, and we still form an LLC, but we kind of call it a JV deal. Hope that helps.
Yeah. You have one other question? Definitely. Well,
Because you could sell it to your apartments.
100%. Yeah. We always have local property managers manage the property, and the property managers have to have at least 5 to 10 years experience in the market. For us, that's just something that we have across the board. But a property manager will always give you the time of day if you tell them that you are looking to make a long-term investment and grow your portfolio in that market. Now, when you first start out working with them, it may be like 8%, 10% they might charge you. But knowing that as we accumulate more units, that price is going to come down. And you talk to them about that. And you can usually get them down to start out with, as long as they believe that you're actually going to like scale in that market. And every market's different. Some markets are 5%, some markets are 8, some are 10. Just depends on, usually the more units it is, the less they charge you. Just economies of scale, right? Anybody else have questions?
And that's all negotiable too, by the way. So we'll get into that in the property management, building the team class, but yeah, go ahead.
Yeah. We got.
How are you guys factoring in the interest rates? Well,
What was
Yeah.
the question?
How do we factor in interest rates? And that's in our underwriting models. Like, we have a calculator that we use to evaluate deals, basically, and we test everything. So like, what if interest rates go up? Right now, specifically, we're trying to exclusively target fixed debt so that it'll be fixed for the next 7 to 10 years. And we won't have to worry about interest rates. And great, if they come down, maybe we'll refinance, but we're not planning on it. That's how you kind of plan for it, really. Yeah, what do you got? Devin, you gonna say something?
Yeah, I mean, I think we're going into like maybe a later class, because I do have to get going here in a little bit to meet up with some people. But Commercial debt is a little bit different. It's very different than residential. So I'm not familiar with your experience in the classroom here, if you guys sell mostly residential or commercial, but usually there can be a balloon payment, like where you have to pay the whole entire balance of the loan after 18 months or 24 months or 36 months if you're doing like a bridge loan, which is kind of like the hard money loan version for apartment buildings and commercial loans. So while the market was going up, and this is market cycle, people were doing that. And what we're seeing now maybe is that we are going to have some opportunities to buy because those people need to sell and they're not able to refinance because rates are so high. And so that to explain further what Aaron said, right now we're looking for those balloon payments to be 5, 7, and 10 years out in case there is a recession. And yeah, one of the reasons we had to cancel the deal that Aaron saw in Northwest Arkansas is because we had a purchase price in mind, and then we shopped around all the lenders we could find, and the rates were high. And we told the seller, okay, we need it to be this price, and they said no, and so we're canceling. Because we're not getting into a deal where it doesn't make sense.
Yeah, and the rates change every day. It is a different world, the commercial loans versus residential loans. So it is worth having conversations with people about. And we'll get into that. And like, it's all comes down to building your team. Once you've isolated a market that you want to be in, then it starts, okay, I need to find the people that are operating at a high level that I like to do business with, because those are the people that are going to work for you and with you. And they're going to help you grow. They're going to help you make sure that you're not making a stupid decision. Does that make sense? Cool. What time do you have to go, Devin? You have to leave now?
I can do a couple more, probably 2:30 there.
Anybody got any more questions for the moment?
With what you guys are showing us today, what you're sending us, what are a couple of things that we can be working on between here and the next month?
Find markets you like. I would love for next month when we come back for you to have like 3 markets that you're like, this is what I love and this is why I love it. And maybe we can find, I've talked with Devin about it. Maybe we can come like a half an hour early or something and sit down with people and talk about what they found. But that once you get all this stuff, evaluate markets, find ones that you're interested in, and find reasons why.
That's a great question, and maybe the most important question of the day, because you can learn everything about apartments and investing and not take any action. And so taking action is super duper important. Like, you don't want to get into analysis paralysis mode. And so we've given you so much, and we don't want you to be paralyzed in like fear. Oh my goodness, this is so, I hope you're feeling energized and inspired. So that's an awesome question. Like, all you have to do right now is take the spreadsheet that we're going to send with some of the stuff that and we could send the recording of this link if you want, and go down and find some markets that are cool and that excite you. And the other thing, especially because Aaron had said before, like, we don't come from money. We that's why, like, the limiting belief in our head was like, we couldn't buy these things. But if you find a good deal, and this is down the line, but if you find a good deal, you can bring it to people with more experience, like Aaron and I, and which we did with some of our partners to start, or we still do. And then we can buy them together. So that's how we form partnerships. So if you're saying, oh, I don't know if I'll ever be able to do this, it's like what I said earlier, 1% better every day. And so from now in the next couple of weeks, learning how to underwrite these markets and find markets is a very attainable goal that you can do. And you can always call us or email us if you say, hey, I got this down, what should I do next? But we are always looking for deals and always looking for good deals, and are happy to partner with people that bring good deals.
Yep. That's the easiest way to get started, is find a deal, because the money will find you. The experience will find you if you have a good deal. Any other questions? No?
Awesome. Cool.
Thanks
so much for us.
Wait, hang on one sec. Yeah, I'm gonna shoot a video for social media real quick.
Oh yeah, I got to do that.
Since you're on the screen. Hey everyone, it's Rob from Katie Doing Vision. We just finished our first series with Aaron and Devin on syndication, 12-week series. We look forward to seeing you the next time. If you didn't make it today, DM me and we'll get more information to follow. Thanks so much, guys.
Bye.
Okay.
Nice. You did it. That's good. That's great.
Thank you. Appreciate it.
Thanks, guys. Appreciate it.
Take care, guys. See you guys.
Later, Devin. Have fun out there.